as a self-employed or a small business owner, and when there's, you could see income coming from different streams within the business, and then they want to go out and invest in property, what sort of advice or what recommendations you give to those sort of clients?
As a business, let's say I'm running a restaurant as a sole trader, people can actually sue me, and if I get sued, all my personal assets get sued. But hopefully the property in trust has a very clear from the Company Protection Act, and then I'm protected. It's extremely important for a business owner to keep their personal assets separate from the business. And trust, in many cases, they can hold their assets individually as well, but trust in many cases give that asset protection strategy. If you're running a business, 100% think about an asset protection strategy. Speak to an accountant who can then draft it all up for you and then explain that in a way that how your asset that you're building over and over a number of years can do.
Welcome to our Property Investor Series. Today we have Ash from Clear Tax Accounting. Ash, I often get asked a question from our property investors that what structure we get into. Get into a personal name, buy a property in a company name, a trust name. And I say, okay, I'll take a step back. You need to first go to an accountant because you don't want to get unnecessary ATO letters. So what's your take on that? What do you recommend that as a good structure?
Absolutely. So there's no one set answer to this, Aseem. Every single client is different. Situations are different. Objectives are different. For example, someone wants to build a portfolio and someone else wants to have one property in the lifetime. So it's really important for an accountant to understand what is that client intend to achieve or an investor intend to achieve and recommend a structure accordingly. As you've rightly mentioned, there are various structures. For example, one can buy a property in a company, in a trust, or an individual name. So it purely depends on what is that trying to achieve, how aspirational they are from their property perspective, how diversified they want their portfolio to be, and basis that we recommend a structure to the client.
Excellent. That's a lot to think about before you get into a property structure. But I buy an investment property and I feel okay, it's a good location. I might move into that property. What happens when you move into an investment property, which is partly owner occupied now or partly investment, and then we sell that property? How does the negative gearing come into effect? And if we sell a property, there's a capital gain tax, and these are a lot of the information which as a common person we don't understand, but a lot to unpack there. So what would you say to them?
I'll try to simplify the response on that one. It's just a bit complicated, but let's assume a person has bought a property and lived in the property, let's say for 2 years, and moved out of that property for next 5 years. And just probably, let's say the person is from Melbourne, they've moved to Sydney for next 5 years for work reasons, and they're not really able to live in that property that they have bought, but they have initially lived for 2 years. And for 5 years, they've not been able to, and then move back in. So there's a 6-year rule that applies to that. So even though that property is an investment property for the individual who is now not living in that property for last 5 years, still the person is able to sell that property at a 0% CGT because there is a 6-year rule that ATO allows you to obviously relocate as long as you do not have any other PPOR or principal place of residence beside this. So if the person is moving from Melbourne to Sydney and have bought a property in Sydney and start living in that property, from that date, the Melbourne property ceases to be a PPOR and this will be taxable from that date. However, if the person just lived in there on the rent and never bought a property in Sydney and lived in that property and moved back into the Melbourne property, then that property has always been a PPOR, even though they're allowed to claim all the interest and deductions and stuff like that for the last 5 years.
Right? That's a lot to think about. Yeah. And you mentioned something about the expenses. What are some of the expenses you can claim? And if you want to elaborate into that CGT space as well, more for investors.
Absolutely. And I will also cover the other side of the stuff. What if the person has bought the property as an investment and then start living in there? So now that property is an investment property. And I'll come back to the expenses in a minute, but I'll try to cover the two sides of the coin as well. One is the person has actually bought the property as a PPOR and then it becomes an investment property. So in that case, it's a 6-year rule apply. However, if the person has bought the property as an investment property initially, let's assume the reverse the equation. That means 2 years it was an investment property, and now they start living in there, and then they sell the property after 5 years. So that means 7 years in total acquisition phase, 2 years an investment property initially, and 5 years as a PPOR. They have to pay CGT for the first 2 years. You see the reversal, and the way they calculate it is 2 divided by 7 multiplied by the gain, and that's the amount that they have to pay CGT on.
Those numbers to work on over there.
Yeah.
So that 2-year period, you've got a CGT rule that you get a 50% discount. Will that apply to those 2 years?
Yes, that will be applied. Yes. So they will still be able to claim the 50% discount on that. But what I'm trying to say in these 2 examples, even though for the 5 years this property has been their PPOR, still is not an exempt. In the other example, even though it's only 2 years that principal place of residence, the property is fully exempt from CGT. You see, so all this discussion generally happens with an accountant. Initially, I mean, when you are making all these complex decisions, always speak to an accountant. I will also answer the second part of the query is some of the expenses. I mean, there are heaps of expenses you can claim for the investment property. Obviously, I think logical reasons, anything that you're spending on that property, you kind of claim, for example, the repairs, the water, the water rates, and the council rates, the interest component of it, the depreciation element of it. So there's a long checklist that we can find on the internet that we can claim, but more or less, in that range.
I was hoping you would talk about a Bali trip, which I can claim, but unfortunately, that's not the case. So there's a few things we need to take that into consideration.
One hidden expense I would still mention on that is LMI, which is quite relevant for all of us. So whenever, I mean, this is the most common expense, which I think it's ignored over and over. So if you have paid LMI that on an investment property, that can be depreciated over 5 years, which a lot of people do ignore because they're not sure how to claim that.
That's a good point. LMI is very relevant as a mortgage broker, and that's something we find often as, someone who's getting into the market. They want to know how much maximum they can go for, and LMI applies if you're borrowing more than 80%. And some banks allow you to go up to 90% where LMI is applicable. And it's good to know that it can be claimed in a staggered way, and that way it's clients are not that worried when they hear the word LMI. They say, I don't want to pay the cost, but can be claimed.
Yeah, can be claimed over 5 years. Yes,
that's good. One thing I always say to my clients, when you can't retire on tax losses, so make sure that you cover all your taxes. Speak to an accountant before making any decision. And the other portion which comes, I want to build my property portfolio. Now, structures of trust and company are often talked about. Why is that the case?
Especially, I mean, when someone is trying to build a property portfolio, I think trust are kind of a way to go instead of company alone. And the biggest reason is, I mean, there are a few instances where company is relevant, but in most cases from mom and dad, I think trust is a way to go. And the biggest component here is capital gains tax. So if you have earned a capital gains on a trust, you get a 50% discount if you sell the asset after a year, likelihood. If you do that in a company, you don't get any discount and you pay 30% tax flat. So hence, it's more preferred to have an asset within the trust as compared to a company. However, I'll give you an example where the company could be more preferred. For example, let's say someone is running a business. They have heaps of money as a retained earnings in the company. They're not really sure how to deal with that money. In those cases, probably it will be one of the options for an individual or a business owner to set up another company, loan the money to the company loans, obviously following all the regulations there, as well as acquire some assets within the company using that cash sitting in the company because it's just not doing anything for them if their intention is to buy a property. So in very rare circumstances that, sort of where generally small business do not have that spare money sitting somewhere, but if they do have that money sitting in a company and strapped, then one of the options is to cash on that money, is to have a company to company structure with the compliances and then able to acquire a property through a company. But in most cases, mom and dad probably wants to hold the assets personally or through a trust structure with a corporate trustee. and obviously able to captain that 50% CGT savings in the future, because anyone who is investing into property, hopefully they're willing their property will go up in value, and when it goes up in value, you want to pay the lowest tax possible, and trust kind of helps you with that.
There's a question which often comes up as well with the structure is about the negative gearing. So, and negative gearing plays a key part when we are doing the borrowing capacity. Will the negative gearing apply to company or trust, or is it only applicable if they're buying it in a personal name?
Right. So let's take an example of a trust, because that's the most common, and I'll try to explain it with an individual. Let's say you buy a property and the property is $5,000 negatively geared. If you're an individual and you are a, say, 100K salary as a PAYG, what you would do is you would take this entire negative gearing against your PAYG income, and you will probably, your taxable income will be 95K, right? So you save $5,000 of taxes on that in that year. In the trust, what you're allowed to do, you're not allowed to take that against your income or PAYG income. What you're allowed to do, you're allowed to carry forward it up to 80 years or the life of the trust. What it means is, if in year one it's a $5,000 negative geared, and year two, let's assume, is a $3,000 negative gear, you are now carry forwarding a loss of $8,000 for the third year. And in the third year, let's say you got a $10,000 of gain. So you're not going to pay tax on $10,000. You're only paying tax on 10 minus 8, which is 2. So you're only paying tax on $2,000. So it's just a timing difference within the trust, which probably in the individual, I mean, it's good to have a cash flow and stuff like that. And, I understand why people would prefer on an individual name, but you are limiting a lot more other options, or you are limited in options when you buy the properties in an individual name, which hopefully will come up in the conversations. But when you go with the trust, it's just a timing difference is what I see with the negative gearing.
And as a self-employed or a small business owner, and when there's, you could see income coming from different streams within the business, and then they want to go out and invest in property. What sort of advice or what recommendations you give to those sort of clients?
Again, it's extremely important for a business owner to keep their personal assets separate from the business. And trust, in many cases, they can hold their assets individually as well, but trust in many cases give that asset protection strategy. Trust with a corporate trustee, of course. So what it means is, as a business, let's say I'm running a restaurant as a sole trader, people can actually sue me, for any reason. If I've not done a good job, and if I've messed it up, and people can sue me, right? And if I get sued, all my personal assets get sued. But hopefully the property in a trust has a very thick layer from the Company Protection Act, and then I'm protected. So the property in a trust is kind of protected. So that way, I'm not putting all my eggs into one basket. So if I get sued for any reason, whether from the act that I've done on Facebook, right? I've done a common comment on a business, and they have tried to sue me, and then they have successfully sued me, and then I have to declare bankruptcy. Again, my asset in a trust is kind of protected, whereas my assets. So if you're running a business, 100% think about an asset protection strategy. Speak to an accountant who can then draft it all up for you, and then explain that in a way that how your asset that you're building over and over a number of years can be protected.
Yeah, and over the years, as a property investors, once you get the structure right, you want to build your portfolio. And a common question we get asked as well about the borrowing capacity, and how can they maximize it? How can they leverage as much money from the bank as they can? Isn't it? That's the $1 million question, where the next $1 million is coming from. And my quick response to that: first of all, make sure your personal liabilities are to as low as possible. So when I say personal liabilities, is your credit card, your personal loan, to reduce it to as low as you can, and put a right structure in place. And don't be too confined to the major banks. Certain banks allow a higher amount of rental to be calculated towards a borrowing capacity, and that way they can boost up the amount they can borrow to buy the next property. And more the leverage, the interest and all that will play a part in the negative gearing, and then they can claim all of these expenses. So look, it's been a great discussion. Thank you, Ash, for being part of this property series, and I look forward to hearing a lot more client stories.
Thank you, Aseem. Thank you for having me. Thank you, MoneyQuest as well.